Live. It's time now for the big picture. Let's welcome in Collin Martin, Director and Fixed Income Strategist, Schwab Centre for Financial Research. A very good morning to you, Collin. Thank you so much for joining me today. What is the fixed income market telling you about how people are feeling about day 7 of this government shutdown?
I'd say the fixed income markets are saying that things are okay right now. We're not necessarily seeing any sort of flight to quality similar to what we're seeing in the stock market. No sell-offs just yet. In fact, we continue to see stocks generally moving higher. We're seeing the same in the bond market, whether it's short or long-term yields. They're both trading range-bound, suggesting that investors aren't necessarily worried about the potential impact. Because if there is some sort of risk-off rally or economic slowdown because of the potential loss of output, that usually would result in investors going into high-quality investments like U.S. Treasuries. We're just not seeing that right now, especially long-term yields kind of hit trading range bound. And we're also seeing it in the credit markets, just like the stocks I mentioned, continuing to generally go up. Credit spreads, both investment grade and high yield, the risk premium that we as investors earn to lend to and invest in corporate bonds are very, very tight right now, suggesting there's not much caution about the future prospects there. So despite the shutdown going on to week number 2 right now, or day 7, there doesn't seem to be much of a concern in the bond markets.
Okay, you say Fed rate cuts or whatever the magnitude doesn't mean that all Treasury yields move in unison. Just unpack that for us. What are you expecting to see then?
Yeah, that's a great point, and we like to highlight with our investors, but it also matters for consumers. When you look at what the Federal Reserve rate cuts mean for different types of bond yields or borrowing costs, it usually has a direct impact on short-term yields. So from an investment side of the equation, Treasury bill yields usually fall with and in anticipation of Fed rate cuts. We see the same thing happen with very short-term CD yields, for example, maybe 12-month maturities or less. Money market fund yields tend to invest in Treasury bills or Fed repurchase agreements, things like that. So they're all very, very related to short-term moves in Federal Reserve policy. When you move to longer-term yields, like the 10-year Treasury, for example, they're more indirectly related, and they tend to track not just what the Fed is doing in the here and now or at the next meeting or two, but what the path looks like over the next handful of years. And it looks more at the long-term growth and inflation expectations there. And we're not expecting long-term yields to really fall much from here, even if the Fed does cut rates either as we expect, one time this year, or even if they cut as much as the markets are expecting a handful of times over the next few quarters, because inflation is still just really high right now. Inflation's generally near 3%, well above the Fed's target. There's fiscal concerns with the path of our deficits and what that means for debt markets. And we're also seeing other global market bond yields rise, which kind of leaves room for our yields to trade kind of range bound for now versus falling as a lot of investors might expect. So if you're considering long-term yields, they might not fall, but that also means mortgage rates might not fall. And I think that might be a disappointment for a lot of consumers out there.
Yeah, that's certainly been key to the conversation, hasn't it, Collin? Because a lot of people are sort of anticipating that with some of the Fed rate cuts, that it could actually mean that mortgage rates come down. But as you say, there's just so many moving parts, and that steepening of the yield curve, there are expectations that that's going to continue to be driven by, the lowering of the short end with all the, I suppose, the situation now with what is happening in global fixed income. I mean, you saw Japanese bond yields spiking overnight. I believe that 10-year hit the highest level since 2008 and the 30-year record. So, I mean, that's sort of keeping things in check and sort of floor under the 10-year here for now. Just wondering what the next big sort of catalyst is in this sort of government shutdown. I mean, we've had the absence of data. When does it sort of become a problem that starts to sort of weigh on the minds and we saw sort of more meaningful move here in fixed income?
Yeah, I don't have the exact date or number of days that the government is shut down, but I believe that the longer the shutdown goes on, the more of a risk it is to the economy and the global markets. I think a lot of it comes down to the expectation for Fed policy. So right now we are missing, we can just say one key data release. Last week's job report is very important right now because all eyes are on, the softness of the labor market and how much it is weakening. In the absence of that data, knowing that there's a meeting later this month, The Fed will probably just continue with the trend it saw. We saw some softening in the labor market. They didn't get necessarily confirmation or something proving otherwise, since we don't have the data. So a cut this month, seems pretty likely right now. That's what the markets are pricing in. Beyond that, though, if we're missing 2 months worth of data, if this were to continue, that's where we see the risks, because the Fed really needs to see how much the softness is there. Is inflation still sticky next week? If we don't get the CPI report, that's a risk. And that just makes an already uncertain outlook even more uncertain. And the Fed, I think, is going to be in a really tough position.
Yeah, the picture starts to get murky, and herein lies the complications for the Fed. Collin Martin, always a pleasure. Thank you so much for joining me today. That is Collin Martin, Director and Fixed Income Strategist, Schwab Center for Financial Research.